Imagine this, you living life on your terms, free from financial worries. Picture a world with financial freedom, where your money doesn't only work for you, but this fictional concept of making zero work becomes a tangible reality. Ever wondered how Warren Buffett, the renowned investor, achieved such extraordinary success through dividend-paying stocks? Are you curious to learn the secrets that can empower you to create a steady income stream and build lasting wealth? Everyone has a different idea of how they want to spend their days of retirement. While some may think living comfortably, getting a mortgage, or moving to an affordable place might be a better solution, investors strive for that sweet comfort of investment dividends hitting their bank account. Gone are the days where you had to spread your legs according to your coverlet. We live in a smarter era now. The era of investing and making smart money through dividends.
The answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain. And there are many businesses. Take See's Candy, which we own.
Warren Buffett, who is known for his successful investment career, is a strong believer that dividend paying is a key to successful investment. According to Warren Buffett, dividends are a great thing, but they're only really effective for passive income when you either have somewhere over 20 to 25,000 shares of high-yielding stock, meaning you'll likely need to have a few hundred thousand, if not more, invested. Reinvesting dividends back into the same stock certainly does snowball with compound interest, but you only really start seeing it after 20 years of never stopping, and likely needing to add additional money of your own with it. In short, if you have $1 million at some point, that'd be enough to create a portfolio that would pay you between $50,000 to $70,000 in dividend income. Warren also said, if you want the recipe for getting rich in the stock market, here it is. Find stocks with above-average appreciation potential and safe and growing dividends, and then buy them at attractive prices. Today, we will tell you how you can make money through dividends. This is your foolproof guide on Warren Buffett's proven method for achieving financial independence by living off dividends. Let's explore the strategic steps that can potentially earn you a steady income of $2,470 per month. Warren Buffett, renowned for his investment prowess, has shared invaluable wisdom on dividend investing that can help anyone build a solid financial foundation. Let's delve into the secrets behind this efficient approach to financial freedom. Before jumping into the technicalities, let's understand what dividends actually are. The whole idea of dividend investment is to put your money in businesses that are going to make a profit. When a company makes a profit, it can decide whether the profit will be used for growing the company or to pay shareholders. Imagine you are a shareholder by owning some of the company's stocks. If this company makes a profit, it can use the profit to spend on growth or pay shareholders like you. This is called dividend paying. It revolves around purchasing shares of well-established companies that consistently distribute a portion of their profits to shareholders. Unlike relying solely on capital appreciation, dividends provide a steady income stream, irrespective of market fluctuations. Warren Buffett is a staunch advocate of this approach, and for good reason. This dividend could be paid to you in a form of a check, a cash, or could be reinvested to buy more shares of the company. If a company decides to distribute its profits to investors, then the dividend amount will obviously depend on the amount of shares you own.
Distributes cash to shareholders, and then it repurchases shares in a big way, which returns cash on a selective basis to shareholders, but in a way that benefits all of them. So you will benefit from us not paying dividends just as long as we can use every dollar we retain to produce more than $1 of value.
Buffett thinks that dividend-paying companies allow investors to compound their wealth over time by purchasing additional shares with reinvested dividends, resulting in an ever-growing income. This concept is completely consistent with his long-term investment mindset. He believes that anything that promises you a quick and shortcut way to make money, it's not permanent. He managed to make a name for himself and become the envy of even the most experienced investors by keeping his eye on the price and not being swayed by flashy investment trends. Buffett once said, "We select such investments on a long-term basis, weighing the same factors as would be involved in the purchase of 100% of an operating business. Number 1, favorable long-term economic characteristics. Number 2, competent and honest management. Number 3, purchase price attractive when measured against the yardstick of value to a private owner. And number 4, an industry with which we are familiar and whose long-term business characteristics we feel competent to judge." Buffett assures that his wealth grows regardless of stock market swings by investing in companies with a history of increasing dividends and long business practices. Before investing, conduct thorough research on potential dividend stocks. Focus on companies with a strong track record of dividend payments, stable earnings growth, and low debt. Buffett famously values businesses with a competitive advantage, also known as a moat, which ensures their long-term profitability. So, what is the strategy that you could use to achieve your goal of earning $2,470 per month? Here is how to strategize and meet your goal.
Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably.
Like Buffett said here, when it comes to dividend investment, diversification is the best tool. You can make a huge profit when you understand that it is not wise to keep all your eggs in a single basket. Investment is not a walk in the park, and just like Warren said, the first rule of investment is don't lose money. And the second rule of investment is don't forget the first rule. You need to make sure that you don't lose your hard-earned cash. Buffett emphasizes the importance of diversifying your dividend portfolio to reduce risk. Invest in companies from different sectors and industries to spread risk across various economic cycles. Buffett's most successful investments have been held for decades. He advises investors to adopt a long-term perspective, resisting the temptation to engage in frequent buying and selling. The power of compounding can only be fully realized over extended periods.
In the 60s in Disney. So there are companies we're familiar with. We generally sell, we would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years. 40 years ago, my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also didn't want to borrow money. So I would reluctantly sell something that I thought was terribly cheap to buy something that was even cheaper. Those were the times when I had more ideas than money. Now I've got more money than ideas, and that's a different equation. So now we sell really when we think that when we're reevaluating the economic characteristics of the business. In other words, if you take don't want to name names, but take a stock we've sold of some sort. We probably had one view of the long-term competitive advantage of the company at the time we bought it, and we may have modified that. That doesn't mean we think that the company is going into some disastrous period or anything remotely like that. We think McDonald's has a fine future, we think Disney has a fine future, and there are others. But we probably don't think that their competitive advantage is as strong as we might have thought.
Another important thing is that when choosing dividend stocks, balance the current yield with the potential for future dividend growth. While high yields might seem attractive, a company's ability to consistently raise dividends signifies financial stability and growth potential. Buffett also encourages investors to reinvest dividends back into the same stocks or other attractive dividend-paying opportunities. By reinvesting, you amplify your holdings and enhance your income stream. Now that you know the basic principles of dividend paying and how you can use essential tools like diversification and Warren Buffett's long-term investment approach to make money while basically doing nothing, what is the next step? The fastest and most effective way you achieve the dream landscape of financial freedom is through dividends. But how? Here are 3 simple steps you can achieve in real time. Want to know one way to successful dividend investments? They are called ETFs. ETFs are the simplest and quickest way that you can live off dividends. They allow investors like you to make money through stock appreciation as well as dividend paying. Buffett suggests establishing your dividend portfolio with dividend aristocrats, or companies that have increased dividends for at least 25 years in a row. These companies have proven their dedication to paying shareholders, providing them with a solid basis for dividend-focused portfolios. Invest in blue-chip companies that have strong financials, huge market capitalizations, and a track record of surviving economic downturns. Even in difficult times, these corporations frequently retain reliable dividends.
Passive investment, I've written about it. A passive investment in aggregate is going to beat active investment because of fees.
You did this as a result because you wanted to show people that they didn't need to be trying to beat the market all the time, that they could just be investors over the long haul, and that would be a way to make money.
And that they didn't have to pay 2 or 3% a year to somebody to get those. And average results were going to be very good.
Right.
And they've been good all my life, and in these 10 years they've been good. You've done perfectly okay with passive investment.
For beginners, or those with limited time for individual stock research, dividend-focused exchange trade funds, or ETFs, can be a suitable option. These funds consist of dividend-paying stocks across various sectors, providing instant diversification. ETF is one great way to make a lot of money through dividends. Well, the ETFs invest in stocks, but also write a call option on those very same stocks. It is a genius way to make additional money since these call options give buyers an option to buy those stocks during a certain time at a specific price. So, an investor can make an insane amount of extra money with this if the call sells off stock. Moreover, if stock prices rise above the call option strike, ETFs can recognize capital since it will be required to sell those stocks. Now, there are several popular covered call ETFs that you can consider, for instance, XYLD, OILK, and EWZ. All of these ETFs had significantly higher yields than a lot of traditional dividend stocks. To be specific, XYLD has a yield of 11.83%, while the other two offer a generous yield of 11.82% and 11.83%, which pays you off in 2 digits and is insanely good for you to make the $2,470 a month. This allows you to have a steady stream of income while living off your retirement days doing absolutely nothing. In addition to this, many companies offer DRIPs, which allow you to automatically reinvest dividends to purchase additional shares, often at discounted prices. DRIPs can significantly accelerate wealth accumulation. Patience and discipline are essential characteristics of dividend investment success. Warren Buffett frequently emphasized the significance of being invested through market downturns and not panicking during volatile periods. Buffett urges investors not to make investment decisions based on emotion or fear. Instead, concentrate on the company's fundamentals and long-term potential. Like Buffett once said, there is nothing wrong with a know-nothing investor who realizes it. The problem is when you are a know-nothing investor, but you think you know something. Market fluctuations and news headlines can be distracting. One thing you should always keep in mind is Warren's investment philosophy. This includes looking at the long-term approach rather than being swayed by the current market situation. Buffett recommends maintaining a long-term outlook and avoiding knee-jerk reactions to short-term events. Define your investment strategy and stick to it. Consistency and discipline will yield better results over time. You have to regularly review your portfolio's performance and make adjustments as needed. Monitor the health of the companies you've invested in and be prepared to make changes if their fundamentals deteriorate. Now, if you want to determine the monthly income you can generate from dividends, you can do it easily by following these steps. Calculate the dividend yield. Divide the annual dividend per share by the current stock price to find the dividend yield. Estimate your investment. Determine the total value of your dividend portfolio by multiplying the number of shares you own by their current market price. Projected monthly income. Multiply your dividend yield by your total investment value to find your estimated monthly income. According to Warren Buffett, never depend on a single income. Invest to create a second source. Warren Buffett's dividend-paying plan is a tried-and-true way to achieve financial independence. You can develop a sustained income stream and accumulate wealth over time by investing in dependable, dividend-paying firms with a long-term outlook. Remember to diversify, reinvest dividends, and maintain patience and discipline in your approach. Always conduct thorough research and review the performance of your portfolio regularly. While dividend investing may not yield instant riches, it does have potential for consistent and considerable long-term gains, as one of the world's most successful investors, Warren Buffett, has discovered. If you embrace the power of dividends, you can have your way to financial security and a brighter future.